Good morning and welcome to Unusual Activity powered by FinancialJuice.com with George Avedon and Milton Marmonides. Thank you for joining us this 20th of February 2015, a frigid morning in New England. Certainly, we have a fantastic guest today. Gordon Scott will be joining us in just about 15 minutes or so. Looking forward to having a conversation with him. Certainly, lots happening in the marketplace this morning. The continued headlines out of Greece, out of Ukraine. Certainly, keeping an eye on Middle East. We'll get into that in just a few moments. But certainly, we are keeping an eye on all of these headlines as they impact market volatility. We do have S&P futures this morning lower by 3.75 at 2091.50. That is off the low, and that is off the high of the morning. Again, currently at 2091.50. Crude oil is higher by 24 cents at $52.07. We have gold higher by $3.80 at $1,211.40. We have the 10-year meandering right in that 2.080. A little bit of a higher yield late yesterday afternoon, but again, right around that 2%, 2.080. 30-year is at 2.705. We legitimately had a close to a 50 basis point move on the yield in the 30-year from about 2.2 to currently 2.708. So again, very interesting on that. Strong U.S. dollar again this morning at 94.651, higher by 0.247. The euro weaker this morning, certainly with all the headlines coming out of Greece and the Ukraine. We'll get into the headlines in just a moment. At 1.1314. So what we'd like to do, let's dive into yesterday's activities just briefly. We had the Dow Jones lower by 0.24% by 17,985.77. S&P 500 we had lower by 0.11 at 2097.45, and the Nasdaq was higher 0.37% at 4924.70. Certainly in Asia, certainly the festivities are going on with the Lunar New Year. Let's dive into, we like to start off the day with geopolitical macroeconomic news. We certainly went through the future of markets this morning. We'll touch on that periodically as we're having conversation with Gordon and throughout the program. Certainly keeping an eye on Middle East, specifically ISIL. Lots of headlines coming out with respect to ISIL and counterterrorism efforts by various countries. A lot of headlines. Will they, won't they impact markets? It depends. It depends on the headline. It depends on how the market digests that particular headline. But overall, the market seems to have digested, at least for the short term, most of the ISIL related headlines coming out from the Middle East. Also out of the Middle East, certainly what we've been discussing is the fact that oil has clearly has gone up from the 44 handle to currently that 51.89, where we tend to get above that 52 as well. We'll get into the technicals in a little bit, but really we're looking for any specific any rhetoric from, or posturing, if you will, from OPEC countries, Saudi Arabia. So again, keeping an eye on that. We'd like to get into some of the specific headlines on your screen there. You'll see headlines that we pick out during the morning that, again, interesting to note and interesting to see how the market reacts to this. So let's go through them one by one here. So um, Hollande says there is no Grexit, there's no Greek exit scenario. Greece must stay in the Eurozone. Um, Also, Hollande says Greece must meet commitments. Greek Greek vote must be heard by EU. So certainly a little bit of a defense there on the part of Hollande. Um, Continuing with Greece, EU official says that it is unlikely a deal will be made tonight. So again, as these comments are coming out, we'll certainly discuss them with you as we go through this. Um, Now, a few other uh, officials are commenting about the Greek Austrian Chancellor Feynman tells Reuters Schwably rejection of Greek proposal was exaggerated. This, according to a Reuters exclusive interview. Um, so again, lots of information, and folks, and this is something that's really important. Until there's actually a resolution, we're going to continue with this rather uh, incessant, nonstop commentary and opinion and so forth, and it does tend to affect volatility. It does tend to affect how the markets react, at least in the short term. So again, we're looking for a resolution. We're looking for some kind of headway, some kind of indication that there is an agreement, and we'll go from there. The other piece of geopolitical in Europe, of course, certainly with the Ukraine. Certainly, we've been in a ceasefire situation, but again, a plethora of information is coming out relating to whether or not the ceasefire will hold, whether it will not hold, violations of both sides, and so forth. So, again, we feel that this is just going to be an ongoing issue, really, until look, our opinion is that until Russia actually pulls out or shows indication that aggression is coming down to nothing, the news is just going to continue. So that's something to keep in mind. And again, Merkel, we want to bring this up. Merkel reiterates that the Western powers may consider further Russian sanctions, and this is something that we've been hinting at for quite some time. That it's probably coming. It's probably more sanctions are on the way, and it's not that the fact that there's more sanctions is what Russia will do with it. In response to that, to those sanctions, and specifically its relationship with China. We've been talking about this. Not much has been discussed about this, but again, China is going to come up as a major partner for Russia, we feel, at least in the short term going into 2015. We have Yellen on the macroeconomic side. We have Yellen speaking on the 24th and 25th of February to the Senate and the House. One of the things, and we'll bring this up in just a moment, and that is this notion of productivity and this notion of capacity utilization. Typically, historically, rates tend to go up when productivity can no longer basically productivity impacts capacity utilization, and to prevent bottlenecks, that's where those rate increases basically enter the picture. But again, we're keeping an eye on that. We talked about Juncker, just a recent headline coming out that basically Juncker commenting there will be no Greek exit, and this was commented in a German magazine. This morning, uh, report of Baltic Dry Index at 513 points, higher by 0.4%. We have it is an increase, but it is near record lows, the Baltic Dry Index. So this is an index that tracks container ships activity with respect to such things as grains, and raw materials. Additionally, this morning we're anticipating at 9:45 a PMI manufacturing index flash, and at 10 o'clock we have the Atlanta Fed business inflation expectations, and that's just certainly we take each number, certainly with a grain of salt, some caveats, but interesting to see if there's what's the what that number will be and if that will affect the markets. Remember, inflation is on the minds of a lot of folks, specifically that it's been a lower than expected inflation rate, and certainly with oil being down, and so that impacts CPI, PPI numbers, obviously. But again, we're continuing to keep in mind. So the themes of the day, folks, is a continued euro volatility, as we've been seeing now. Euros in the 112 area, 1.1. Actually, just ticked up 1.1300. So again, just between that 112, 113 area. U.S. dollar strength, clearly we've seen that day in and day out. Continued oil volatility. We're anticipating this just to continue. It's not, the volatility is not going to let up until it finds a level, and we'll get into the technicals. Um, Central bank commentary. We talked about this. We're waiting for Yellen to discuss the economy and specifically productivity, specifically capacity utilization, and specifically wage growth, average wages. So that's something that we know that they keep an eye on rather closely. Um, the proverbial Greek drama. This is going to continue, folks. The EU commentary, posturing by both countries, until we get an actual signed agreement, is just going to continue, folks. Treasury yield curve. Um, right now, the 5-year at 1.539, 10-year 2.075, 30-year 2.701. Keeping an eye on that. Will that flatter yield curve continue, and how will interesting to see if Yellen mentions that in her commentary next week, and certainly keeping an eye on global politics and economies such as Russia, and specifically EU's and Russian relationship post the Minsk meeting, and what Russia will do next. So it's a great drama, folks, and obviously we're coming to the end of earnings season. Volume seems to have come down a bit, but certainly we'll get Gordon's input on that. And of course, we're keeping an eye on the Ukraine-Russia situation, especially into the weekend. Um, so one thing we always we like to interject this when we discuss Russia, something very interesting. Certainly, the oil has impacted how it functions, perhaps maybe made a little bit uh, a little bit more aggressive, if you will. There's certainly some internal strife within Russia. We want to see the reaction to the West, what kind of reaction they have, and again, keep in mind a little bit of a caveat, folks. Putin's approval rating is extremely high in Russia, so that's something to just keep an eye on. So we can take a look at, before we get to Gordon, just a few moments, we can take a look at what's happening in Europe currently. We have the FTSE higher by 0.19%. We have the CAC in Paris lower by 0.71%. DAX in Germany more or less flat, down by 0.05%, and the IBEX in Spain lower by 0.79%. In Asia, The Nikkei was higher by 0.37%. The Hang Seng higher by 0.19%, and the Shanghai higher by 0.76%. Keep in mind there are festivities still going on in Asia for the Lunar New Year. We'll take a look. We like to put this up for folks that trade the oil markets. The top of your screen is a list of oil ETF ETFs that we like to keep an eye on. Specifically, OIH certainly has like the Schlumberger larger holdings. We have the Halliburton larger holdings, and really what the volatility in those ETF and ETNs are, certainly what the impact of oil is on producers, CPI, PPI data. And again, these comments we have on just to keep folks honest here. When we hear of analysts coming out with certain numbers for certain futures or commodities, we always like to keep them honest and remind folks that we're keeping an eye on them in terms of their opinions. And we'll take a look. So we're just about at that 9:15 spot. Let's run through crude oil currently at $51.72, gold at $1,208.10, platinum at $1,162.40, and the 10-year at 2.073. So, folks, we are very glad to have with us Gordon Scott. And this morning, Gordon, good morning to you.
Good morning. How's my sound? Am I coming through okay?
You're coming through quite clearly and well. Thank you.
Excellent. Thank you for having me, George.
A pleasure. Thank you for joining us. Gordon, first and foremost, thank you for coming on, and please take a little bit of time to introduce yourself, what you do, give us a little bit of background about you and your involvement in the capital markets industry.
Thanks, George. Well, I hope I don't sound too immodest by saying this, but although no one else has ever described me this way, I'm looking forward to the day that somebody might. I like to think that I'm probably one of the more, if not the most, influential guy in technical analysis that you've never heard of. And what I mean by that is there's a lot of ways that I'm involved with a large number of players and institutions and people who are involved in technical analysis, helping to shape the discipline, helping to teach people, and as a result, I have a lot of influence on the things that you might hear about in technical analysis, but you wouldn't necessarily know that I had anything to do with that.
Okay.
And just to give you an idea,
Sure,
for the past 10 years, I've been involved in developing curriculums and certification programs for the people who teach technical analysis. For 5 years, I was the curriculum developer and education manager for Investool's TD Ameritrade. And, a lot of people throughout the world went through the educational programs there, and those were largely courses that I helped to either refine or develop, or worked with, some of their specialists in the formerly Thinkorswim brokerage and some of the other trading gurus they had in place to really invent indicators and trading system methods and so forth. I currently do a number of things for various outlets. Let's see if I can share my screen here and show you a little bit. So right now, let's see if that screen is coming through.
Yep, there you go. Let's take let's expand on that a bit. Okay.
Okay, so I'm a contributor to Forbes Online,
Okay.
and they have a great speculations news feed, which the headlines go from there to a variety of other places, Finance, Yahoo, FinViz, and so forth. But they originate here, and so if you actually want to follow me, that's where you would want to go to do it. That's the URL there. Blogs,
Great.
Forbes.com, people, Gordon Scott. So
Very cool.
I put up just news headlines there, maybe 1 to 3 a week that are mostly technical analysis. Well, and in addition to that, a couple of years ago, I co-authored a book with Tony Turner. The title of the book was Invest to Win. It was published by McGraw-Hill. And we put together this book with the idea that we wanted to have something that people could use to just be very low maintenance. They don't want to change their lifestyle. They like their life the way it is. They're successful, but they got money in their 401k, and they got to do something with it. What are they going to do with it? How can they protect themselves from 2008? How could they make sure they're participating in the last 5 years of the market, right? So we did some research over the past 100 years and found a simple methodology that would allow us to help people take advantage of that by just spending 15 minutes to half an hour first weekend of the month every month, and sort of a set and forget strategy. It's pretty simple, pretty nice, nothing glamorous, but it tends to work. And in fact, some of the indicators from it, if we have time, I can take you through
Sure,
and show
absolutely.
that to you. But that was found to be so interesting that there's a new brokerage on the scene. I mean, a lot of people would say, "What a new discount brokerage? There's no room for that. Why would anybody
Right.
do that?" But these guys, I came across them, and they came across me actually, and approached me and said, we like what you've got in the book. Would you be willing to be one of our education providers? We're going to start up, but we don't want to. We want to have somebody that's not part of the brokerage. It's not official, because we don't want to have to be seen as giving advice ourselves. But
Hmm.
we know that our people need some sort of strategy guidance, or at least things to consider, but we only want to work with people who we trust, and who we kind of believe in their system. Well, they came to me, and there are three of us that they decided to work with. One is my book, and another is a sort of step up from that, the Learning Markets courses, to which I also contribute some content and commentary for. So that's been kind of fun that we've had a chance to get involved with Drive Wealth. They're a great group of guys. They're formerly Forex dealers, so their idea is that they want to make trading very simple for the 20-something crowd. We're not talking about day traders or high frequency types. More like people that just kind of want to manage an IRA, and or 401k, want to do a little self-directed trading, and have a reasonable chance at expecting it to do well. They want to participate in large cap U.S. stocks. This profile, I mean, there are a lot of younger people that fit that profile, but there's also people all over the world: China, India, Singapore, and the rising middle classes in those areas, but also in Japan and the Middle East and in Europe, where there's a significant number of people that want access to U.S. stocks, but they're not necessarily able to have a simple, low-cost way to do that. This brokerage aims to address that market as well, with the potential that down the road they may have the ability for people to access stocks 24/7 in local currency. So that could be a really interesting breakthrough product. I'm hoping that they manage to put that out. I'm having a lot of fun being associated with these guys because they're a great group of guys, and their
Sure.
whole idea is just keep everything as low cost as possible, make it available to as many people as possible. So one of the things that they've asked me to do is to do a video newsletter, and so I'll be launching that with them back on this page. It'll be available, but it's only going to be $4 a month. It's going to be a great product.
Great. No, I think that's great. Having that availability for the masses, for the general public, for the general investing public, if you will, I think is critical. May I ask? I mean, what are you? Let's keep it a slightly macro level. Let's see. Well, question for you: Do you do any intraday type of suggestions? Maybe swing trade type literature.
Um, I am not currently doing that, but I
Okay.
do. Yeah, and in fact, there will be some that comes out as part of that video newsletter. But I have both the sort of larger, longer term macro view as well as the short term, position kind of trade, 1 to 2 months in a stock, or even a short trade, 2 to 5 days kind of presentation. So some of the things you'll see in the Forbes articles, they're mostly talking about 1 to 2 month long kind of trades. But this article right here is an example focused on how Tesla, coming into earnings, had a really unusual opportunity. It had just broken its downward trend line, was sitting there, and the news, the potential for big news on Tesla is constant. People are always reading into the tiniest little thing on Tesla and then projecting it forward by orders of multiples. Um, Tesla right now is being priced as if it's going to become the next major car company, which is really shocking if you think about it. And yet, people don't think that that's such a crazy idea because Elon Musk and what he's doing, the way he's got government subsidy essentially for his company as a startup, and he's really done things that people don't expect, and in doing so has created a space where people look at Tesla and say, could they, the market's kind of pricing as if there's a 30% chance that they'll be the next major competitor to GM and Ford. I mean, that just sounds ludicrous when you think about the number of cars they're putting out, but in reality, it's not such an off the over the top prediction, and we know that because GM and Ford are both preparing aggressively to launch serious electric car offerings
Right.
in 2017. So if they take Tesla seriously, then surely the
Sure.
market can take them seriously.
Sure, no doubt. I mean, do you also? I mean, in that context, do you? What's your? I know it's very far off, but what's your thought on Apple, and even rumblings of them getting into the car market?
Yeah, so that would just be yet another amazing thing for Apple. Let's forget about cars for a second.
Right.
Apple, I've written about in the Forbes articles
Please.
several times, and one of the things that well, here's the article here. If I could
Mhm.
just bring this up,
Please.
that this was a little while ago, back when Apple was pulling back on its weekly chart. I mean, I really liked it on a daily chart, but I felt like people should realize how good it was on a weekly chart.
Mhm.
Back at this time when the price was in between 120 and 115, and the most aggressive price target that any analyst out there would say was 130. And my
Mhm.
read of this was, hey, this thing is going north of 130, and if the earnings come out strong, like I expected them to, then it's going to go even higher. And as soon as the earnings came out, of course, price targets went higher, and people are now saying things like 145, 140, 150 for Apple. But the reason I got to tell you, the reason I knew that that was coming was that over the break, over the Christmas break, I went to turn in my own personal Android phone, which I'd had for 4 years, and see about the possibility of upgrading. I didn't think I was going to do it, upgrade to an iPhone. I didn't think I was going to do it for another 2 or 3 months, so I was just on a fact-finding mission. But I got in there and found that I use Verizon as my provider. Verizon had this really aggressive offer that just made it a no-brainer. And I thought, you got to be kidding me, really? Because basically Verizon is going to subsidize my purchase of an iPhone 6.
Right.
And I compared it side by side with my phone, and sure enough, it was a little bit quicker and a little bit better. And I thought, okay, I'm going to go ahead and try this. But then as I looked at the math, I mean, Apple makes a bundle of money doing this. Verizon makes a bundle of money doing this. But I, as the consumer, I pay a little bit more, but not much. And compared to what I have by having an iPhone, it's a big value. And I realized that value proposition was going to be hard to resist. Verizon's, the major carrier for iPhones. I mean, it's spread out pretty nicely, but Verizon's there, and if they were doing it most aggressively, it was pretty obvious to me what was coming was that Apple should have a good season. Well, they did. I mean, a good earnings report. Well, they did, but let's look further on. The Apple Watch. Okay, it's not out yet, and Wall Street analysts are not really thinking that it's going to do anything much. That it's going to do anything big. But if you look at what the Apple Watch is technologically, that's a major disruptor. It is not really a watch. It is a wearable computer. It's got a tiny little interface, and it's a nice, innovative one. And as a watch interface, it's really cool. It does a lot of neat things. As a computer interface, it's terribly lacking. So they're not going to talk about it as a computer, but the reality is it is a high-powered piece of technology that could fit on your watch and could be a major workflow disruptor over the coming years. Let me give you an example. Apple Pay. Everybody's talking about Apple Pay. Visa came out with the study they did. The results of that study said people are twice as likely to carry a cell phone as they are to carry cash. So that fact is mildly interesting. You could have guessed that on your own. What's really interesting about that headline is that Visa said it. So if Visa is out there looking for it, then that means they're gauging how far do we go with this thing? How much do we sort of encourage and try to push people towards Apple Pay? Well, that statistic tells you they are going to push it. They are going to be interested. And I can't think of an easier way for anyone to use Apple Pay than combined with an Apple Watch. Just imagine you're standing there at the counter, and you don't have to fumble in for your wallet, find your credit card. You don't even have to pull out your cell phone, get it to the right screen, and wave it. You just wave your watch. A single hand motion, boom, it's paid for. And it's secure. It's not going to get hacked. I the other day, well, actually a couple of months ago, I was riding the subway in New York City, and I didn't realize it, but I happened to have an old credit card, like a 6-year-old credit card, that was still active in the bag I was carrying, and it didn't have the RF chip in it, so somebody actually scanned it and hacked it and started making purchases, $10,000 worth of purchases. Well, those got all nullified before they did anything, but it was stunning to me that I'm just carrying a credit card in a bag. I didn't use the credit card. I haven't pulled out that bag for months, and as I'm walking along in the subway, somebody's war driving or whatever they're doing, grabbing that that data right off my credit card. Well, nowadays credit cards, have the chip in them that keeps that from happening. But Apple Pay's mechanisms are going to be even more secure than that. It's going to take a little while for people to catch on to it, but they're going to realize using Apple Pay is safer than using a credit card. And if you had something like an Apple Watch that made that even more simple for you to do, that would all of a sudden become desirable for people. And so I think it'll take a little while for it to catch on, but when it does, I think there are a lot of applications inside the technology that have yet to be exploited. Now, on top of all that, imagine you've got an Apple Watch and you walk up to a car and it opens because you tapped your watch once. Imagine that it starts up. Imagine that across anything you do with your smart keys, you do with your watch, right? You can see that Apple, even if they don't buy Tesla, if they just buy a stake in Tesla and begin to integrate this technology into automotive, I mean, people are thinking, what? Apple, trillion-dollar company, it's got no room to grow. Hey, folks, we're just getting started on where Apple could end up going.
I agree. I think it's from a technology perspective, I certainly think Apple has upped the game a bit in terms of availability of the products to the general public, and really pushing the envelope of what the general public may do in the future. So I agree with you there. Gordon, tell us what taking a look at, you've written books, you've talked to folks. Certainly we've been in a very volatile environment over the past, let's say, call it a month and a half or so, since the beginning of the year. How are you, at least suggesting, how are you telling your educators to speak with subscribers and clients to really understand this market a little bit, how to position themselves in this market, considering the volatility?
Okay, well, I hope I don't go over time here.
No, you're good. You're perfect.
Okay, yeah. Let me know if I start running along or whatever. I'll try to keep this as concise as I can. But I want to go back to the book, because what we did in the book was we actually came up with this notion of trying to read the market's mood by distilling it down to 3 simple indicators. Another reason that I talk about myself as being influential is I also work with the Market Technicians Association. I am the managing director of the CMT program. Now that's a certification like the CFA for technical analysis. And I'm in charge of the development of all the exams and the curriculum that goes into the exams. And the reason I bring up the MTA at this point is that I wrote the book and we published it with McGraw a couple of years ago, but then just last year, a year after we published, the Market Technicians Association awarded its annual Dow Award to Michael Guyad and Charlie Bolello, who came up with a sector rotation methodology. And they worked completely independent of Tony and I, and they were doing something academic, and we were doing something more in the retail space. But what was amazing here was that they came to the same conclusion we did. They had looked over the data, and basically the big news was that you could use the utility sector as an effective tool in coming up with a bellwether for when to be in or out of the markets. And the idea there is that the utility sector is a safe haven for institutional investors. So if you see money flowing into the utility sector, that's a pretty good signal that institutions are heading for safety and that there's trouble ahead. So the methodology that I developed, maybe I could show it to you here. Let's see. I apologize. I thought I had it. I'm going to bring it up on Freestock on a different screen, but you're going to like this once I am able to show it to you. So give me just a second. And what we do is we just compare very simply the S&P 500 with the utility sector, and we look at the range, average true range of the S&P 500. So the black line here is the S&P 500, the red line is utilities, and then down here the brown line is the average true range or historic volatility. And the indicator goes like this. If you have a 2-month sequence where the utility sector outperforms the S&P 500 and coincidentally the S&P 500's average true range climbs for those same 2 months. If you have those 2 months in a row, that's what we call a stop sign signal. We in the book we just kept it really simple: stop sign, go sign. The idea is that if you're in a go sign market, you should be mostly, if not all, invested in stocks. If you're in a stop sign market, you should be mostly, if not all, invested in bonds. If you want to reduce volatility, you come up with some sort of mix of the two. But for a younger crowd who's got time on their side and wants to have a more aggressive opportunity for outpacing the markets, and they can handle a little bit of the drawdown, then that's what you do. You go all stocks or all bonds based on whether it's a stop sign or go sign market. Okay, so the triggers for whether you're in a stop sign market is to see the stop sign signal, but then the second thing is to watch to see whether prices go below the 12-month moving average of the S&P 500. So if the S&P 500 dips below its 12-month moving average, then and only then do you actually take action. So this is how close we got. If you see right here, during the months of December and January, the S&P, as you mentioned, it did sort of lag, and volatility had definitely increased during that period of time, and utilities were just on a tear. And then all of a sudden, the end of January came, and everything changed. Now, I had been telling people, keep an eye on it, because if the S&P 500 goes any lower, if SPY hits 196, then that's going to be your trigger point. That's going to be the point at which you should move your money out of stocks and put it into bonds. But it never came. It didn't happen. So where are we right now? Well, we've escaped the jaws of a bear market, so to speak. And if you had a rule like that, which is, okay, I'm ready to act, but I'm not going to act until, then you stayed active. You're still long the markets. And option volatility, if you look at the VIX, it's dropping down a little bit, and if you look at the rate of change of the VIX, it's declining. So all of those signals are bearish. But sometimes what the VIX will do is it'll get bearish. It'll look like it's going to be bullish, when all of a sudden it'll pop up and go higher. So what I like to do is look at the VVIX. The VVIX is actually the volatility on the VIX. It's kind of weird, but basically what it does is it gives you a further out view of what's coming, and increases the significance of the signal. And notice what's happened here on the VVIX. It has dropped way down below its former lows. So just here in the past 2 or 3 days, not only have we got the what I was showing before, the fact that, okay, this is a rebound, we're more than halfway through the month, it is not likely that the utilities are going to outperform the S&P index. And so that means the clock restarts. Now we'd have to have a whole nother 2 months of volatility and utilities outperforming the S&P 500 before there's a risk of a bear market coming. So there was a very significant risk. We were just a hair's breadth away from starting into conditions that would have taken us into a bear market, but those have so dramatically reversed, and everything else is lining up with it. The VVIX confirming. This tells us basically that number one, we're not going to go into a bear market anytime soon, the next 4 weeks or so. Number two, unless something unexpected happens, that some heavy selling takes us down to new lows, for example, It'll probably take a couple of months for the conditions to reset back up again and create potential for bear market. So where we're looking right now, we're much more likely to continue to be bullish despite all the Eurozone fears and so forth.
Sure. Gordon, and that's great. Take us, if you were to, list maybe, top three things that you're, I don't want to say concerned about, or at least top three things that are, in a something that you're absolutely looking out for in the next 3 months, with respect to not 3 months. That's wrong. Well, yeah, let's say quarter. Yeah, 3 months. Where whether it's Europe or whether it's deflation risks, what are you most what is on your radar? It could be technical, it could be fundamental, it could be headline news. What's on your top three things that you're keeping an eye on? Just to let her, as we're finishing up here, take us away a little bit. What you're keeping an eye on.
Okay, sure, great. So I'll tell you the number one thing that that I'm looking at over the next 3 months, which is driving my decisions personally. And if anybody's asking me, this is what I'm explaining to them. And this number one thing is so important; it occupies all three of my top spots.
Okay, please go ahead.
So what I noticed, and I published this in the last chapter of the book, Invest to Win. Is a little market theory that I have that I haven't heard anybody else really talk about. The idea is very simple, and there's actually a fair amount of persuasive evidence for it. But it goes like this. U.S. investors, not all of them, but some of them, have a tax incentive associated with the holding period. So in other words, if you hold on to stocks for 1 year or longer, then you can, when you sell them and take profit, you'll pay taxes on that profit at a long-term capital gains rate. And that rate is, 10 or 15% or lower, depending on your tax bracket. For high net worth individuals, people who are likely to have a lot of stocks, let's say a CEO of a Fortune 500 company who retired a couple of years ago, and he took a bunch of shares with him because he got paid in stock. Well, he can't really sell the ones he just got. He's got to hold on for a certain period. And then he's looking for any of the stuff that he just got, sort of his golden parachute clause, to watch and see, well, when can I sell these? It makes a big difference if you're somebody who's holding on to 1 million shares of stock and deciding whether to sell half of that, as an example. It makes a big difference how much tax you're going to pay. Here's a little fun fact for you. Microsoft now pays a dividend, but it hadn't for the longest time. The very first, it hadn't since its beginning up until a few years ago. Well, the very first time it paid a dividend, it paid a $3 dividend all at once. The stock dropped from $29 to $26 overnight to adjust for that $3 dividend payout. Now, individual investor who walks up and buys 100 shares the day before does not get to participate in the dividend, and then all of a sudden sees the stock drop $3. If he wasn't paying attention to the news, he's going to be very, very disappointed with that decision. But you look at who that decision benefited. Bill Gates had so many shares of stock that when he took a $3 distribution on all the shares that he held, the amount of taxes, the amount of money he saved in taxes, okay, keep this in mind, the amount of money he saved was $90 million. I mean, that's how when you realize Bill Gates personally saves $90 million in taxes, then you know you can at least infer what a big motivation for that size of dividend and the timing of that dividend would have been. Well, look, if Bill Gates is the kind of guy who's smart enough to figure out, gosh, if I take dividend payouts, I make um, I save money in taxes, and to a guy like him, a high net worth individual who's of the top upper earning or upper tax bracket, he's going to do that. Well, I came across this possibility because I talked to a lot of fund managers and a lot of high net worth individuals, and they all said that same thing. I don't care what I buy. There's no way in the world I would ever sell it in less than 366 days because I want that tax benefit. And so that's what got me thinking, okay, that's got to show up in the markets. If enough people do this, it's got to show up in the markets. And it turns out that, yes, in fact, it does. If you look at the S&P 500 over a long period of time, you can find 56-week periods where this shows up. So let me just show you an example that's so blindingly obvious, it will knock your socks off to consider. March 9th, 2009, you go 56 weeks forward from there, and you come to April 26th. Nothing important about that day. But 6 days later, 6 trading sessions later, is the flash crash, 1,000 points down on the Dow. A lot of people want to say, hey, that was all about high-frequency trading and computers messing things up, and it was grease, and there was all sorts of other stuff at the time. It's just possible that although all of those things contributed to the nervousness of the market, that none of those were the actual instigators of the action, but that what was just this simple fact. For 4 weeks coming off that bottom, you had a violent upward move, and a lot of people bought in. A lot of other people were, closing out shorts. There was obviously a short squeeze in there, but so many people bought in that 52 weeks after that, they are now collectively sitting on a huge profit. I mean, the markets went up 60% from here to there in just that 1 year's period of time. They're looking at a huge profit, and they're saying, I can now, as of this week, 1st of May, sell and take profits at a lower tax rate. Because I've earned so much, it's crazy for me not to consider taking some off the table. Well, if 1 or 2 or 5 or 10 people do that all at once, it's no big deal. But if 100 or 1,000 or 10,000 people all do it at the same time on the same day, that's how you get something like the flash crash.
No doubt, no doubt. Gordon, thank you. This is certainly rather enlightening, interesting perspective, and certainly, I'm sure, helpful to our viewers and listeners. Folks, you've been listening to special guest Gordon Scott, market technician, consultant, educator, author. Gordon, thank you very much for joining us this morning on Unusual Activity.
Thanks for having me.
Thank you, and we hope to have you back again. Have a wonderful day, and wish you a very prosperous day. Folks, thanks for joining us on Unusual Activity, powered by FinancialJuice.com, with George Avedon and Milton Marmonides. Wishing you a great weekend. Have a great day, and good hunting.